Well, hi there, everybody, and thanks for joining to learn about options trading mistakes to avoid. My name is Jason Ayers. I'm a derivatives market specialist by designation. I'm Director of Business Development and a derivative strategist with RN Croft Financial Group. I'm also a member of the Investment Review Committee here at Croft, as well as a member of the Board of Directors and educational consultant for LearnToTradeGlobal.com, along with being an educator for the TMX Montreal Exchange. As always, we want to make sure that everybody understands that the information we're going to be discussing here today is for educational purposes only. The options market, not unlike any financial market, does have its risks, and we just want to make sure that everybody understands those risks before they start trading live in their investment account. So what we want to cover during this session is just a look at some of the common mistakes that novice option traders make as they begin to integrate various strategies into their portfolios. The first we're going to discuss is the idea of using an all-purpose strategy. We'll discuss options pricing and the idea of buying what would be considered to be a bargain or cheap option. We'll talk about the mistake of ignoring implied volatility being a very important pricing variable within the options market and something that all investors need to be aware of. And then we'll finally wrap things up with the mistake of disregarding earnings and dividend payment dates. So getting started here, let's take a look at using an all-purpose strategy. Well, we all recognize that options can be used under a variety of market conditions. In fact, this is what makes the understanding of the options market very valuable. But it's important to recognize first and foremost what your objective is and what you're trying to accomplish when looking at the options market, because that's ultimately going to dictate which strategy is going to be the most important. So, or most effective. Now, when an investor does understand that the dynamics of the options market, they can construct a strategy that is going to be much more effective at meeting their unique objectives. It's important to remember that each strategy has a number of different unique considerations. So first of all, there's risk and reward. So different option strategies have different risk reward profiles. Some have limited risks with unlimited return potential. Others have unlimited risks or undefinable risks with limited return potential. So you really want to make sure you understand the logistics of the strategy before you click the trade button, so that you're aware of what those risk reward considerations are. The impact of time depreciation, again, dependent upon whether or not you are an option buyer or an option seller. Time depreciation is going to have a very different impact on the profitability of the trade. And so before entering into the position, you really want to just make sure how time depreciation is going to impact your position. The impact of implied volatility changes, again, very, very important consideration, which we'll touch on later on in the presentation. But implied volatility will expand and contract based on market conditions. And you want to make sure just what implied volatility is doing to your strategy, and what the implied volatility considerations are for the current market conditions, so that you can choose the most appropriate strategy. Commissions as well, again, the more what we would call legs to a trade. So legs would be just different contracts and positions, being used to create a specific strategy. So the more contracts being used, the more legs to a position, the more commission intensive that's going to be. So again, you just want to be aware of how that's going to impact the profitability of your trade. Complexity. So again, there are very, very complex option strategies that one could implement if appropriate for the market conditions. But depending upon your experience and depending upon your confidence level, sometimes the more complexity is not always the best strategy to select. Ease of management, understanding how the strategy works and understanding how to not just get into the trade, but get out of the trade are all very, very important considerations as well when you're looking at implementing an option strategy in your portfolio. The reality of it all is that each strategy is going to perform differently depending upon market conditions. And what we really need to make sure we do is first and foremost assess market conditions and determine what our objectives are. We need to then research all available option strategies to find what the best strategy is going to be based on those objectives and market conditions. And we then need to create a plan to manage that position. Trading and investing is very much a function of probabilities. So what we really need to do is make sure that we are controlling and making, and controlling as much of the variables or as many of the variables as we can when entering into a position, because ultimately that's what's going to give you an edge. Every little bit that we can control, whether it is effectiveness in management, trade execution, commission costs, the appropriate option strategy for the objectives that we're trying to reach are all going to help to give us an edge and ensure that we're putting ourselves in the best possible position for profitability. And finally, once we've done all of our due diligence, then it's time to execute the trade. One of the biggest challenges I've seen faced with investors too is just managing trade expectations accordingly. And so the recognition again that each strategy is going to perform differently depending upon market conditions. So whether it's a long call, whether it's a long put, whether implied volatility is low or high, when creating the position, whether you've implemented a spread strategy, whether it's a credit or debit spread, all of these different types of strategies are going to be impacted differently when a stock or an exchange traded fund moves higher or lower. And so having that understanding, recognizing the logistics, the dynamics of the strategy that you're implementing will also help you manage your expectations accordingly and make much better and more educated decisions in managing through the position. The other consideration and mistake that I often see made, in fact, it's probably the first mistake I ever made, is the idea of buying bargain or cheap options. Many investors are looking to use options to leverage their capital, and the idea is that the cheaper the option contract, the more contracts I could buy with the money I'm looking to allocate. But the fact of the matter is, while out-of-the-money options are cheaper or considered to be the most inexpensive, they're priced based on the probability of whether or not they're going to be in the money on expiration. So if you think about it, the reason why an out-of-the-money option contract, which is an option contract with a strike price that is a fair distance away from the current underlying value, the reason why they're priced less expensive than, let's say, an at-the-money or an in-the-money option contract is because the market is essentially pricing a very low probability into that particular contract that it's going to be in the money on expiration. So the way that we can interpret this is that the market believes that that option is likely going to expire worthless. Now, there are reasons why we might want to purchase an out-of-the-money option contract, but they're cheap or less expensive for a reason. And again, you need to make sure that you're purchasing the strike price that is appropriate to your objective. So, for example, if I was looking to purchase an option contract because I was looking at it as a stock replacement strategy, my strike price selection would be dependent upon what my expectations were on the underlying security. If I felt that the stock is going to make a significant move in a short period of time, I may consider to go with the less expensive, further out of the money option contract. But if I felt that the stock was going to make sort of a bit of a conservative move over a certain period of time, I may be more inclined to choose an at the money or slightly in the money option contract. As the option writer, if my main objective was to generate cash flow, and I didn't care if the stock got called away from me, I would probably go at the money, collect the higher premium, but I would be aware that it's likely that the shares are going to be called away. If I was looking for capital appreciation on the underlying shares that I was owning, and I was just looking for a moderate income through the option writing strategy, then I might go for a further out of the money and benefit from the capital appreciation of the stock more so than the income generated through the option writing approach. And so again, options are priced based on probabilities. They are more expensive or less expensive for a reason. We have to understand what those reasons are and then make the appropriate selection. So when we take a look at a strike price comparison here, looking at call options that are all expiring within a 2-month period, let's say that stock XYZ is trading at $53.66. What you'll see here is that at a strike price of 50, you've got a more expensive premium. It's slightly in the money at $4.40. It has a higher delta. So delta is how much that option contract is likely to move for every $1 move in the underlying security. What you'll recognize is that that it has a higher delta and a break-even point that is, although the option contract is more expensive, the break-even point is really not all that much higher than where their stock is trading at presently, because of the time value and volatility factored into the contract beyond its intrinsic value. When you look at what would be considered an at to slightly out of the money option, the 54 strike, you've got a significantly lower premium, you've got a lower delta, and recognize that your break-even point is in fact higher. So the stock is required to make a more significant move to be in the money on expiration, and so it's priced accordingly. And finally, we go to that way out of the money option at the 58 strike. We look at the premium being 30 cents with a very low delta and a break-even point of $58.30. And so the reason why this 58 strike is priced such as it is because it requires the stock to make a much more significant move within the 2-month time frame that's been allocated for it to be in the money, versus these contracts that are closer to where the stock is trading at that require less of a move. So we can kind of illustrate that a little bit more effectively in a bit of a chart here. And so again, with the stock trading at $53.66, if you buy that at the money strike, that in the money strike call at the 50 strike price, you can see your break-even point is $54.15. If you buy the out of the money, you can see that stock is required to go that much further higher in order to be to break even on expiration. And then finally, you look at this 58 strike, and you can see how much further that stock has to go in order for that option contract to be in the money and subsequently for the position to break even. So when we consider it a function of probabilities, it's real easy to see, well, yeah, there's a higher probability that the stock is going to, move the dollar required, versus the $2 or even versus the $5 associated with that out of the money option contract. So, remember, out of the money options are composed of only time value. Out of the money options will have a greater return when a quick and volatile move occurs. However, the probability of that option expiring worthless is high, and as a result, the option contracts are priced accordingly. Whereas at the money options and in the money options are more expensive, but offers the investor intrinsic value and a higher probability that there will be a value on expiration, as the option is more likely to be in the money. Expiration month selection as well is a very important consideration. So again, we want to remember that options are priced based on their relation to where the underlying security is trading, and that's where we reference in the money, at the money, and out of the money contracts. And we also have to understand that options are also priced based on when they're expiring. And so shorter term options are less expensive relative to the longer term expiration dates, but this is due to the probability of the option being in the money or not being in the money on expiration. So the less time you allocate to a particular move taking place, the lower the probability is that it is going to take place. I always use the analogy, if I were to forecast whether or not it was going to rain by the end of today versus whether or not it was going to rain by the end of the week, I would have a higher probability of being correct if by choosing the end of the week scenario. And so options are priced similarly in that the forecast is the stock going to be above this certain price within the next few days, or a few weeks or a few months. And of course, the more time you allow something to happen, the higher the probability it is likely to happen or has the potential of happening. And as such, that probability is factored into the longer dated option contract. And this is why you'll see when we look at the time decay forecast or depreciation chart here, the further out option contracts have a higher premium because the time depreciation factor is much more conservative. It has much less of an impact over those longer dated options. But as soon as you get to the shorter time frame, that time depreciation variable really starts to have a significant impact, and time depreciation accelerates leading into that expiration date. So again, you have when you purchase the longer dated options, there's more time to allow for a move to take place. It's more challenging for the market makers to forecast what variables are going to impact the underlying stock and then subsequently impact whether the options are going to be in the money or not. And so the time depreciation variable known as theta is much lower on those longer dated options, and then speeds up significantly as you get closer to the expiration date, because it's a little easier to forecast within a shorter period of time what the probabilities are. Does the stock have the potential to make a move over 6 months, a $5 move over 6 months, versus can it do that in 1 week? And depending upon the characteristics of the stock, the market can kind of forecast that. If the stock has never made a $5 move within a week ever in its history of trading, then it's a high probability it's not going to happen within the short life cycle left in that option contract, and as a result, the premium will be less expensive. And so again, when you're making that decision, it's really in terms of just strike price and expiration month selection, it's really, really important to understand why they are priced as they are and ensure that you are choosing the contract that is most appropriate for what you're trying to accomplish, and also most appropriate for the stock or the exchange traded fund that you're looking to accomplish those objectives with. Implied volatility. Ignoring implied volatility is one of the, I think, most important considerations and one of the biggest mistakes that novice option traders typically make. So there's two types of volatility that we consider as an options trader. One is historical volatility. So that is the past realized volatility of a stock. So it's quantifiable. We can measure that. It's actually measured by the average deviation from the average price. And it kind of gives us an idea of what the stock's personality is. So we can look back historically and see, is this stock making big swings on a month-to-month basis, and $2 up, $3 down, $5 up, $4 down. That would be considered a historically volatile stock. And what happens is that volatility factor is priced into an option contract, and we measure that by identifying what the implied volatility of the option contract is. That implied volatility is the market's expectation for future volatility. So the interesting consideration is that you could have two stocks at the exact same share price. They could be both trading at $20 per share. Now, on the surface, one would expect that both option contracts would be priced the exact same. But if the $120 stock is a very volatile stock from a historical perspective, and the other $20 stock is not, the one with the higher historical volatility will have more expensive options because of the price swings that take place, which again factors into the probability of whether or not those options can and will be in the money on expiration. So again, a more volatile stock has more expensive options because the stock has exhibited the characteristics of being able to move very quickly in above and below strike prices, pushing those options into an in the money category. So just looking a little more closely at why volatility is important. Implied volatility is the pricing adjustment for risk, and it's going to be impacted by company earnings, pending announcements or mergers, as well as macroeconomic events. So, when you're looking at option premiums, and let's say you're looking at it from an option writer's perspective, you're maybe implementing a covered call strategy within your portfolio. You may be looking at options that are very expensive, and you're thinking, man, this is great. I've got the opportunity to collect some pretty significant premium, to generate some really great cash flow. But understand that that variable is increasing, and you're getting paid because of the fact that you have a higher probability of getting assigned on fulfilling the obligations associated with the contract that you've written. Implied volatility, expansion and contraction is going to influence the option price even if the stock does nothing. So this is where, if there's an earnings report on the horizon, even though the stock may not be moving higher or lower, the market is beginning to anticipate what's going to happen. And this understanding will help you manage your expectations and make better contract and strategy selection. Again, you could be right about the direction of the stock, but if you're not aware that you're paying for a significant increase in implied volatility, the trade may not be profitable. So, for example, you may see a stock move higher based on a positive earnings report. And, based on the delta of the option contract, you maybe get a nice 50 cents or 75 cent move in the option contract. But if the implied volatility component of the premium contracts, that 75 cents or 50 cents that you've generated through the increase in the underlying shares and the influence of the delta may be completely wiped out because you bought the option when implied volatility was high, implied volatility is contracted, and the unit of measure associated with implied volatility is called the vega. So you may have had delta influence the option contract in a positive way, but the influence of the vega and the contraction, the drop, let's say from a 30% implied volatility down to 25%, could completely wipe any of those profits out and completely negate any benefit of being right about the underlying shares. So again, recognizing where implied volatility is, when you're looking to implement the trade, can help you make a better decision. Do you just buy a call option or a put option on its own, or do you go in and use some sort of an alternative strategy, such as a debit spread, bull call spread, bear put spread, which is going to help offset the impact of implied volatility and position you in a much better way to benefit from just specifically the move in the underlying shares. To kind of take a look at how the volatility might adjust from a mathematic perspective, you can see here that, let's say today shares are at $62. We're looking at a strike price of 70. We've got 30 days till expiration. The call option's trading at $2.05. If you've got an implied volatility of 70%, that's a very high implied volatility. You may have a delta of 0.30. So remember, the delta is suggesting that that for every $1 move in the underlying security higher, the option contract is going to generate 30 cents. You may have a vega of 0.06, which means for every 1% increase or decrease in implied volatility, that contract is going to make 6 cents. So let's fast forward to the shares moving up to $66 within a 3-day period. But you've got implied volatility after that move contracting from 70% down to 40%. While you would have a positive influence in the delta of $1.21, the change due to the Vega, so again, for every 1%, so you've lost 30% of implied volatility there, so 30 times 6 cents, reflects a $1.80 contraction in implied volatility premium, which ultimately means that even though the option went up $1.21 because of the delta, it went down $1.80 because of the Vega, with a net result of a 59-cent loss on the position, or your call option that you paid $2.05 for now only being worth $1.46. So you were right about the stock move, but you were wrong about the buying the option contract when implied volatility was high. You got caught up in a volatility crash, or crush as they call it, and you've lost money. And so the only reason why you would have lost money in those circumstances was because you chose an inappropriate strategy to take advantage of the opportunity, whereby had you, let's say, chose a bull call spread instead, you are likely going to be, or would have likely been, in the position of profitability. Finally, let's take a look at the idea of disregarding earnings and dividend payments. Option premiums typically increase ahead of earnings due to implied volatility. So this is everything that we've been talking about here within that last little section, that idea that as uncertainty increases, the option premium will increase to reflect risk and to reflect this uncertainty. So quite often, earnings is a very significant consideration, and so the premium basically is increases in value, or that implied volatility increases in value due to the risk of a surprise, because typically, of course, what is going to be released in an earnings report is not something that is common knowledge to the market, and so based on that uncertainty, that needs to get factored into the option premium. There is an expectation that the stock is likely to be volatile, but the direction is uncertain. And I think it is important to recognize that options are not priced based on direction. Options are priced based on the probability for the stock to move either up or down by the amount of the implied volatility factored in. And so this is where an earnings report could go either way, and as a result, the option contracts need to reflect that uncertainty accordingly. So the typical mistake that is made, and I kind of reflected on this a little bit in the last section there, is that investors believe that the stock is going to make a significant move, let's say lower on earnings, and want to buy a put option to participate, but they don't realize that implied volatility has been expanding, making these put options expensive relative to historic levels. And so when we take a look at just an example here, you've got this volatility, or sorry, this options chain here on a stock that's priced around $45.85. You can see that currently there's a 30-day historic volatility of 14.7. But when we look closer, you can see that within the option contracts, you've got an implied volatility that is in some cases 10 to 15% higher than what the historical levels are suggesting. So what that's telling us is that the market is of the belief, and you can see on the put side as well, the market is of the belief that even though the stock has been trading, with a historic volatility of 14%, and that's annualized, so that's basically 14% times the current price of the shares, and that's what's expected to take place over the course of a year. But what's happening is, as you enter into a period of uncertainty, the market begins to forecast, in this case, a much greater potential for price movement, and that cost is factored into the option contract. So you want to be aware of that, and then subsequently make the appropriate decision. Because the risk, of course, if you buy those contracts now, is that if implied volatility contracts, as I demonstrated in the last set of slides, the option premium will drop in value. And again, this means that the stock could move in the investor's favor, but not sufficiently enough to compensate for the drop of an implied volatility. So you're correct about the forecast, but you incur a loss because of the option strike price selection. Now, the whole idea around uncertainty is that earnings represent uncertainty in the stock price, and there is the potential for a surprise on new information. This could result in a significant move, which is much different than anticipated. And that's really what you got to be keeping in mind when you're trying to build a strategy, particularly around an event, driven sort of opportunity such as an earnings report. And that's why, you have been or will be introduced to the straddle or strangle, or straddle and strangle strategy, which is buying a call and buying a put at the same time. But understand, if that's your strategy to trade an earnings report where you're trying to capitalize on a move either higher or lower, understand that if you're buying a call and a put at the same time and implied volatility is high on both, you are essentially doubling your risk of loss because of an implied volatility contraction. And so you really want to make sure that you are managing for that accordingly. Now, dividends are another consideration. Very important to understand that dividends are already factored in to an option premium. It's one of the variables that are plugged into the Black-Scholes model that helps determine the theoretical value of an option contract. Share values are adjusted lower by the amount of the dividend on the ex-dividend date. This may impact the value of the option contract. As again, because the stock dividend is one of the 6 option pricing variables. So investors trading options need to be aware when dividends are being issued. Really, I think the main consideration for this is the potential for early exercise. So if you are running a covered call strategy within your portfolio and you're doing a lot of at-the-money options because you want to collect that cash flow, there is the potential that you may be assigned early before the ex-dividend date. And the reason being is that if the options time value component that is associated with the call that you've written is less than the dividend issued, then what may happen is somebody may buy the call option and then subsequently feel that there is a benefit of receiving the dividend versus continuing to hold the long call. So, for example, if the time value component on the option contract is, let's say, 22 cents, but the dividend being paid out is 40 cents, then after all the different considerations, that call buyer may say, hey, I'm going to exercise my right early. I'm going to give up the 22-cent time value. I'm going to take the stock and I'm going to collect 44 cents in dividends. So the net result after, ideally after commissions and trading costs, et cetera, is going to be, more than had the call buyer just simply held that position, to benefit from the move in the underlying stock. So in conclusion, you really need to make sure you're planning your actions. Trading and investing is challenging enough as it is. There's a lot of things that are out of our control when it comes to participating within the markets. So if we can identify where, sort of silly and costly mistakes could be made, and if we could create a plan around making sure that we're avoiding these mistakes, then we're going to be choosing an appropriate contract and an appropriate strategy that is reflective of market conditions and really built based on what we're trying to accomplish. It's also going to help us make less emotional decisions so we could focus on the reality of the position and again, by managing our expectations accordingly, we'll be able to make a much less emotional and more tactical and strategic decision. And also we're going to feel in control and be able to execute much more effectively. And finally, we'll manage the risk much more effectively and be able to lock in profits much more effectively by knowing that we did everything we could to choose the most appropriate strategy, and also by managing our expectations, knowing that because of this particular strategy we can't expect a home run, so let's just let's take the profits based on that, managing those expectations. As always, lots of information available for you guys to build on this, these webinars. Of course, you've got the video series available on the National Bank site, but we also have at the Montreal Exchange the optionmatters.ca blog, where there's a lot of great insights from a lot of great portfolio managers and industry professionals. We've got options trading letters, videos and webinars, trading guides and strategies, calculators, simulators, and a really cool little bit of software called Options Play, which allows you to scan the markets for opportunities and ideas, and will help you sort of overlay strategies that might make sense to apply with those market observations. As always, thank you so much for joining in, and I look forward to the next webinar.